Welcome to another chat with AVID, David Harpool and Jack Arnold. Happy Tuesday. It's sunny again this week.
Yeah, it is. It's nice outside.
It reminds me of like a California where we have like low 80s and no humidity. So pretty exciting.
Yeah.
So today, what we want to talk about is really investing, and not so much what to invest in or tactics, if you will, but more the makeup of a good investor. What characteristics and qualities do we believe as professional investors, those who help other people, we invest ourselves, what makes up a good investor? And we think there's some common themes to share that will hopefully benefit you as you go down the, journey of investing. So what do you think is numero uno? Or is there one? Maybe it's just maybe there's no particular order.
A lot of success in investing, and this is really any kind of investing, is having the right temperament for investing. No matter what you do, any kind of strategy, assuming you have some kind of strategy that you're following consistently, is going to fall out of favor. Naturally, it wouldn't give you a return over putting your money in the bank if it didn't come with some risk of it not doing well. As a matter of fact, as long as you have downturns in the market and kind of periodic panics, I would say that's the system working. You should welcome that and say, all right, this thing is it's when there's nothing going on and it's very quiet and it's not doing things, is when you would want to start worrying. It's kind of being the opposite. When nobody else is worried, be worried. When everybody's worried, be kind of excited. This is all right, perfect. This is working. But mostly it's having the proper temperament and knowing that things will go through periods of not doing well, regardless of whatever your strategy is. And you're going to have to force yourself to get through those things, and they can be a lot longer than you think they're going to be. As far as the bad times, it can last a long time. So having the proper temperament, I think, is probably number one. Being patient, having the right temperament, I'd say that's probably one and one.
So basically not doing something emotionally when whatever you have been doing goes in a different direction. The easy thing would be, okay, I'm investing my money today. Things go well, let's say for the next couple months. And then, everybody talks about the summer. There's like the summer lull or the summer fallout or wherever, where typically you'd see U.S. stocks have pulled back in summer months. Is a pretty historical thing, actually. So you'd get into that and then say, okay, this is not working. I need to do something different. So then your temperament, as you're saying, would guide you to abandon what you're doing, maybe be fearful of the kind of hiccup, if you will, in the summer, and you try something different. Is that what you're alluding?
Yeah, mostly. It's more that one is first going into it, know that you're going to be emotional about it. I think sometimes say don't be emotional about it, which I think is the wrong strategy. The thing is to say you're going
impossible.
to be, which is right. Which
is
totally normal. To be
emotional about it.
You're going to be concerned about it. You're going to be euphoric at times. The thing is to understand that that's part of the process, and then not reacting on those things, or at least giving yourself some kind of buffer between feeling the feeling and doing something about it, I suppose. So if you feel just like despondent, like things are horrible, maybe give yourself a little while or write some things down or something just to see, instead of acting kind of just in a rash way where you just go ahead and do something just to do it. Or, if you want to do something just to do it, sometimes you can say, just as an example, I have all this money in this investment. It's gone down a whole lot. I'm not really sure if this is the right thing to do. And you want to sell it all. Well, don't sell it all. Sell 10% of it just to make yourself feel better. Like whatever you need to do to stay in it for the long run, I think would be helpful. So you're going to get emotional about some of these things. You're going to be worried about it, especially, if there's a decent amount of money invested. But it's more just understanding that it's your temperament that is actually probably going to be more influential in your returns over the long run than it is like your intelligence or your cleverness. You know, you don't have to do things that are super clever and super intelligent. You just have to do the right things consistently and just kind of stick with it for a long time. So like I said, that's kind of the first step would be manage your temperament, being patient. So
yeah, I like it. What else?
So, you know, a lot of times when you would be talking, like obviously now we're saying, you know, have some patience, have the right temperament. It's, well, how do I develop that? If I don't already have that, how would I develop that? How do I develop the proper temperament to
can you teach yourself temperament, or is that part of a makeup?
It's probably a little bit of both. I think you probably can teach yourself. Some of it is experience. You know, usually having gone through some things, you'll gain some experience to know, this is like typical. We've talked about quite a few times where, you know, if you go through, people would say, oh, if you're an older person, you should take a little bit less risk, meaning maybe you should have less, you know, higher risk investments. But my experience has been people that are older, that have had more experience with the ups and downs, tend to be more comfortable with it than younger people that haven't. So yeah, they're used to it. Like, this is what it does. It kind of goes up and down. Some of its experience is just going to come. The other way to get yourself in the proper temperament is making sure that you're dealing with the peripheral things. So we have talked about in other videos, you know, if you're including speculative investments, things that I would say are, I don't know, high risk is the right word, but, you know, whatever it might be, cryptocurrencies and all these things, which, you know, they could end up being something, they could not. They probably have an equal chance of being really good and really horrible. You know, they're pretty aggressive. What you don't want to do is not have the proper temperament and then be investing in those things because you feel as though, well, I have to get big returns in order to meet my goals, or I have to get big returns because I want to be rich or something. But dealing with the peripheral things, what am I investing for? What is my time horizon? What kind of person am I? Am I the kind of person that's going to be despondent if my accounts go way down, and by how much? Knowing these things going in and having the rest of your kind of financial life situated will make you a better investor, simply because you won't put so much burden on your investments to kind of bail you out, which is what I've said a million times is, you know, if you're saving enough money, kind of monitoring your cash flow, you have a good plan in place, you're executing it consistently, you know why you're doing things, you're very clear on what your goals are, what your purpose is, and all these different things, you're just going to be a little bit more patient with things, because you'll say, you know, I'm doing this and 90% of what I'm doing is in my control and I'm taking care of that. The other 10%, hey, you know, I'm taking a risk on. It's going to go up and down and I'm fine with that, but otherwise I'm good. It's when you're not doing those other things and all the onus is on your investments to shoot the lights out because you're not saving enough, you don't know what you're saving for, that you start to get like, oh man, if this isn't really working out, then you end up kind of pushing for these big returns, but you end up kind of blowing yourself up anyways, just because you haven't taken care of the kind of, like I said,
so some of the things that could help, you know, kind of build in this resilience is, we always talk about this, but you got to have a plan going into the thing. And a couple of ways to, I guess, interpret plan. One being, what's the investment plan? Is it just, I'm going to buy XYZ that I hear about, or buy, you know, Amazon stock because it shows up at the door all the time, therefore it's a good investment? That would be one thing, like the specific thing. But then also, how do you adjust it? If things are going up, you know, Warren Buffett's quote is be greedy when everybody's fearful and fearful when everybody's greedy, which means just everybody hears the buy low, sell high, which is nearly impossible to follow consistently unless you have an actual plan in place, right? Because emotionally, it's just inevitable. You're going to question it. We do this for a living. We've been doing this for a long time. And I still think there's periods personally where you're in an environment where you say, okay, this is probably a really, really good time. Or is it? Or is it just going to get worse and worse and worse? So you second guess yourself. So having that plan of how am I going to monitor these investments and what am I going to do with the money that's in there so that I don't, you know, I guess blow yourself up or abandon the ship. Because I think part of the resilience of a good investor too is you got to be patient. I mean, we've seen periods where And these are the things that are out of our control. I don't know today if it's a great time to invest, a good time to invest, and we won't know until 5-10 years from now. I'm pretty sure it'll be better. You'll have growth 5 and 10 years from now. But to say, was March of last year the best time in the next 10 years? Who knows? So
right.
You got to be prepared to go into this thing if you're investing with, it could be ugly for a while, or at least not as sexy as you want it to be.
Right. And also there's the unknown, of course. There's, nobody would have thought coming into 2020, obviously now this is like, almost a year and a half ago, you'd have this kind of global pandemic. And in the middle of it, right now, it seems very simple to look back and say, in hindsight, this is obvious.
Wish I would have put money in.
Yes. In the moment, though, it's going to be very difficult to do. If you have some kind of plan in place and you just follow it, even if that plan is just, I'm just going to keep saving money and I don't know, I'm just going to kind of let it ride and things go up and down, you'd be fine. If you were panicking and waking up thinking, well, what should I do? I need to, there's some action I need to take because things aren't going well and you're extrapolating out into the future and all these different things. Yeah, you could end up, not in a good spot. This is the, should I get out of the market because of whatever? We always get questions, would you let me know when it's time to get out of the market? And, we always say, I would love to tell you. The thing is, I don't know. How do I know that today's 10% drawdown is going to be 50% other than just it's the first blip? I don't know in the moment. Sure, looking back, it's easy to say, but there's so many 10% drawdowns multiple times a year. It's impossible to say, this is the one that will end up being something big. And then if it goes to 20, well, how do I know that this is the 30%? Like at some point, it's impossible to really know how far things will go or how high things will go. Like it just
in general, anything. I mean, I think obviously the pandemic we went through, we also went through an election, which we say this in all of our election talks. The same rhetoric happens every 4 years. I think I'm going to wait. I'm going to wait and see how things pan out. I don't care what side you're on. More than likely, waiting is not the answer to good investment. One, definitely a good investment philosophy. And it's probably not beneficial in the long run to wait. So I think but that doesn't mean it's not normal, right? It goes back to the emotional part. Like I invest and manage people's funds for a living, but I'm an investor. I'm allowed to be emotional. So if I have my other ducks in a row, as you mentioned earlier, I think that definitely helps. I'm aware of my finances. I'm aware of my cash flow. I'm saving for purpose. I have realistic expectations. If it falls apart, that's not my, I got to pay the mortgage with that money that it earned or doesn't next month. So all those things help to kind of just weed out that noise. We used to say, there's always noise around you that prohibits you from taking action. Paralysis by analysis too. You just can't do that.
Right. Having a plan obviously is, I would beat it to death, but having some kind of plan of action before things happen. Reacting to the news is, it's kind of too late. And how do you know what the real impact is going to be? You mentioned the presidential election. We would say this person wins, even if you got that right. How do you know how the whatever stock market, whatever investments you're investing in are going to react? You really don't.
Correct.
It's
idea.
Impossible to try to guess that. There's a JP Morgan has a guide to the markets they put out every quarter, has tons of charts and there are all kinds of different things. One of which is they line up these different asset classes. Real estate investment trust, S&P 500, international, all these different gold, all these different kind of asset classes. They line all these things up and they say, what's their return over the last, I think it's usually 10 years, maybe it's 20 years, I'm not sure. And then they put kind of the average investor's return. And it's always 1% compared to all of these asset classes that are doing 6 and 8 and 10 and 4 and 5. How they're calculating that, I don't know. You could kind of say the methodology for how they come up with that might be flawed. Maybe it kind of speaks to my bias. That's the typical case. However, it is on there and it does exist. Why would that be the case? Because it's not that the investments are not performing. The investments are performing. They're doing just fine. It's the individual that's not doing well most of the time. because they're jumping from one thing to another.
Yeah, I think American funds, Franklin Templeton, we used to see them quite a bit. And they did it, and they tracked it based on flows. So they could track inflows and outflows of investors, and basically would look at, 12-month or 3-year, 5-year returns of the actual funds going in and out from people like you and me if we owned it, compared to just the actual net asset value of the mutual fund. And it was probably, I wouldn't say, at least 2 or 3% lower when we get involved, when our habits and our psyche get involved, because we're trying to guess when to get in and out, as opposed to just buy the thing. And it sounds stupid, but just kind of forget about it. Really. Yeah.
Morningstar has a kind of investor return figure that they post for different funds. And, again, the methodology, there's been some argument that the methodology is off, that it's not an actual true investor return. But you can go through and say, and a lot of times you'll find funds that are kind of, or investments that are like the hot thing, or they get super popular. They tend to have pretty poor investor return numbers, because as things perform really well, people pile in. They say, I got to have some of that because it's done well over the last 3 years. And then it turns around, obviously it kind of reverts to the mean, doesn't do very well. Everybody pulls all their money out. And then, of course, as fate would have it, and then it turns around and starts doing well again. So everybody's just kind of in and out, like you said, is the investor's return in those funds isn't good compared to the full time frame. So it's not that the investments are not doing well or doing what they're supposed to do, especially over the long run. It's more the going in and out, changing strategies, guessing, just those kinds of things, not having the proper temperament to actually get a decent return on your investments, which a lot of times it takes time.
Do you think, though, there's my answer to this is no, but a way to really know ahead of time how you're going to react? We were just talking about this today, the whole risk tolerance questionnaire, which is like the industry love word on, if the portfolio drops 30%, how do you react? A, add more money. B, don't touch it. Those things. And they're all over the place. And I think they're a decent, I guess, thought-provoking questionnaire. But in the moment, wouldn't you agree that thing doesn't mean squat?
Yeah. I think asking somebody, what would you do in the situation, and then actually being in that situation, a lot of times are two completely different things. It's not that there's no value in it at all, having the conversation that these things can happen and what would you do, I think is probably valuable just to have the conversation. But no, I don't think it accurately predicts how you will react in a given situation. And none of the situations are that black and white to say, your account's down X, this is what I would do. Because the first thing you're going to think is, well, what if it's down 2 times X? I don't know. I don't know what I would do in the situation because I don't have some kind of plan. Usually the plan would be keep doing what you're doing. Don't do anything out of the ordinary. Just have something set up ahead of time and just stick with it. And don't kind of go crazy and try to be clever and do something, just stop trying to be so smart. Just do the thing that needs to be done over and over and over again.
This probably falls into the plan part, but I think having a realistic time frame in mind for whatever your specific investment is also monumental, right? You don't want to invest in the stock market if you're saving for a car in 2 years.
Well, yes.
So be mindful of that, I guess.
Correct. Yeah, you don't want to be investing money that you're going to need in a year or 2 or 5 for that matter. Yeah, this is all just knowing, like, what's the point? What am I actually after? What things are coming up on the horizon and having some kind of plan. Yeah, because if you are saying I can't even think of an example off the top of my head. Buying a car is maybe a good example, but any number of things. I'm using money that I know I need to use later. And if it goes down by 50% or something, I'm going to be in a bad place. Don't invest that money.
Right.
Just set it aside.
Yeah. Nothing wrong with some cash, even if it's not earning anything really.
Yeah, for sure.
So good principles. Any other thoughts or advice for us trying to be resilient investors?
No, I would say just to kind of summarize, it would be doing well with your investments is not being clever. It's having a proper temperament, and you can develop the proper temperament by just having your affairs in order, I guess, is the summary. So having the periphery in order, making sure that your bills are paid, you have, some cash set aside, how much you're investing, when you're doing it. All these things are set up. It's easier to have the proper temperament if the other things are taken care of. It's just much easier to do that. And then some of the extra stuff will be just experience. You just kind of have to go through it. Sorry to tell you. It's really going to be difficult to explain to you what it feels like to lose money. You kind of just have to do it. So you are going to go through some ups and downs, but having those other things taken care of will make it so much easier to make it through those times so that they don't become permanent
Correct.
impairments of your money, for sure.
I always think of Mike Tyson's quote back in the day where he said, everybody's got a plan until they get punched in the face.
Exactly.
So be prepared and be prepared for change. So thanks for joining us for another AVID Chat. Look forward to seeing you, listening next week. See you Tuesday.
All right, see you.